Hello everyone, welcome and thank you for coming. We will start in 5 minutes. Hello everyone, welcome and thank you for coming. We will start in 2 minutes. Okay, I think we will give it another 2 minutes before we start. So yeah, in 2 minutes we will be starting. Okay, I think we'll be starting now. Hello everyone, thank you for joining the webinar. Before we get started, there are a couple of quick housekeeping items I want to go through. So, mics and video, your mics will be turned off and video disabled. For recording, this session will be recorded and distributed to you by email after the event. And all recordings of the Quorum webinars can be found in the resource section of our website. There will be a survey in the end. It will pop up automatically when you leave this webinar. And if you could give us the 2 minutes and complete that, it would be very, very valuable to us. And in the end of the webinar, we will also have a Q&A session. We will monitor your questions throughout the event, and we will answer them in the end of the session. I think that's that. So let's get started. My name is Kjetil Roe. I am a global account manager for Quorum, and I want to welcome you very much to our webinar today. The webinar is called Agile Planning in Volatile Markets, Maximizing Value from Existing Resources. And to help us out today for this webinar, we will have 3 speakers. We will first have a market outlook, then we will have a presentation about turning data into value. We will have a very interesting discussion getting OMV, one of our valuable clients, perspective. And then in the end of the last agenda point is a demo before, of course, the Q&A. Today's speakers are Aaron. Maybe we start with you.
Sure. Good afternoon, everybody. Welcome to the webinar. My name is Aaron Johnson. I work for Quorum, specializing in our corporate planning applications, and I am based in The Hague in the Netherlands.
Thank you, Aaron. And from our client, OMV, we have Pascal.
Hi, everybody. I'm Pascal Neff. I'm Advisor Economics and Planning in OMV, and we are using Planning Space to support our planning. So I'll be here to chat with you.
Very good. Thank you for joining us today, Pascal. And starting up this session will be Raj. I'll give the word to you, and then you, after introducing yourself, I guess you just continue to your presentation.
Thank you. Yes, good afternoon, everyone. My name is Raj Sen. I'm Senior Director of Business Development for Corporate Planning, primarily focusing on planning space. I'm based in Singapore and really looking forward to the session to speak with Pascal to get her insights and to see the cool stuff that Aaron will show. But let's get started first. I will start off with a market outlook and focus on the realities of today on the supply side. But before we get into the supply side, just like to say a few words on the demand. I think it's quite a general consensus that demand will continue to be stellar for energy. We have a population that continues to grow. Yes, it's growing more slowly, and in the next couple of decades, it will peak before declining, but for the next few decades, it will continue to grow. We have a large middle class that's becoming more affluent, and so as that happens, they're going to need more and more energy. For me personally, the next class of people, we have tons of people that are in energy poverty, and I think we have a responsibility to provide clean, affordable energy to that large group of people. And lastly, we have sort of the AI revolution that requires a ton of energy for data centers, et cetera. So I think it's clear that the demand will remain strong. And although renewables are rapidly growing, wind, solar, et cetera, I think, again, there's consensus that the oil and gas will be the dominant source of energy for the decades to come. So if we now move to the outlook on the supply side, next slide, please. There has been a study by the International Energy Agency that came out just a few weeks ago, so very timely, and it's called The Implications of Oil and Gas Decline Rates. I found this very fascinating. It's a relatively short read, so I urge the participants to go onto this website and read this article, but I'll try to do my best to summarize the key takeaways. What was really informative and surprising to me that from 2019 to date, about 90% of the annual upstream oil and gas investment has been used primarily to offset the production declines. So that's a lot of, that was a higher percentage than I had envisioned. So in 2025, for example, it's estimated that that investment would be about 570 billion. So 90% of that is to offset declines. And the declines are quite significant. So for the post-peak conventional oil, it's 5.6 and 6.8 for natural gas. In this region in Europe, where we're focusing on this webinar, and because of the reliance on offshore fields, that decline rate is even higher at 9.7. You know, places in the Middle East, it's a bit small, it's a bit less, like 2 to 3%. So if you look at those charts, from peak to trough, that's a significant decline over the periods of 2050. But just remember, that is assuming no investment. There will definitely be investment, so it doesn't look as bleak as this, but this is the challenge at hand. So in essence, the key takeaway is the oil and gas industry just needs to run fast just to stand still. Next slide, please. If we look at this in a little bit more detail, for both oil and gas, you will see that the steepness of the curve is getting steeper and steeper as each decade goes on. So basically, the challenge is getting harder. And this is due to heavy reliance on unconventionals. And within conventionals, the mix of conventionals, as I mentioned, like a bigger portion is in sort of deeper offshore wells. So in 2025, if there was no investment, we would see a 5.5 million barrels a day drop. To put that into perspective, that's equivalent of losing both Brazil and Norway in a given year, which is astonishing. Next slide, please. But luckily, we are investing. So this chart sort of shows the investment. Clearly, the investment is not as high as it was 10 years ago. And in 2020, during the COVID period, there was a significant dip. The last couple of years, we've been pretty steady at $600 billion each year. And this year, we're maybe a little bit shy of that. Perhaps that's due to some of the volatility in the oil and gas markets, which we'll talk about in a moment. But I would like to bring attention to the blue bar at the bottom, or that blue wedge. You'll notice, first of all, that's the smallest wedge, and that refers to the money that is spent on exploration. And we'll touch on the importance of that in a moment. Next slide, please. So again, if you look at this chart by territories, or some of the territories, without the investment, you would see the drop in the red line going from left to right. But because of that investment we're making, 90% is bringing that number back up to pretty much where we started. So it's offsetting and mitigating that decline. So that's the challenge. Really, we're on a treadmill, we're running fast, but we're not really going anywhere. And the industry really does need to go somewhere because we need to provide that energy the world needs. So if we go to the next slide, we'll see that this relates to that small wedge of exploration that I was saying. So you can see that every decade, we're actually pretty much discovering less conventional oil and gas. And in the 20s so far, it's the lowest we've ever produced or ever discovered. So this is an extra challenge. So the supply side is extremely challenged for our industry. Next slide, Pete. So this last slide in this section is not from that study. All the other ones are in the study, and I do urge you to read that fully. But I thought it was some interesting observations. This is coming from Rystad data. On the y-axis here, you'll see total shareholder returns and for the period 2020 to 2025, and on the x-axis, you see the contribution to low carbon investments. So if you're an investor, a traditional investor, you invest in the oil and gas industry, you know the risk, there is volatility, but you're expecting high returns, and that's sort of what you're seeing there with Exxon Mobil. But then on the right, you have companies that have invested more in the low carbon. They're a bit more diversified into new energies. But unfortunately, they're not getting the returns. So I'm not sure how this will shape up in our industry, well, whether we'll have this dichotomy or whether we'll have more and more sustainable companies that are sustainably producing oil and gas, but will they behave more like utilities and have less shareholder returns? So we'll have to watch this space, but I think it's quite interesting food for thought. Okay, next slide, please. So now we'll turn to how can we as economists and planners manage this volatility, and what can we do to adapt to this in this environment. So if we go to the next slide. So first, let's look at the volatility. So this graph represents the Brent crude price for the last 50 years. And what's clear here is there's been periods of stability, but there has also been, in every decade, there has been some shocks or some volatility. So in the 1990s, while it was stable, we had the Gulf War. In the 2000s, there was a quite rapid increase in commodity prices, largely driven by the growth of China. In the 2010s, there's been the shale revolution and offsets through the strategy of OPEC. So quite a bit of volatility in the 2010s. And in this current decade, no shortage of activities. So we had the COVID and the crash, where oil prices dropped to negative for a few days. More recently, we've had the Russia-Ukraine war, where gas prices had spiked in Europe. And now we have geopolitical strife in the Middle East. So I would say that, at this point in time, we have relatively elevated prices compared to historical standards, but there's a lot of volatility. So companies will need to plan and operate in this volatile market, and it's not going away. So if we look at this year, we have within the 1 year, clearly this chart is volatile. If you were doing your business planning about this time last year, you were looking at high 70s, low 80s in price. And now, and I didn't check the price today, but we're around 66. So that's about a 10% drop in just 1 year. So so again, the importance of working in a volatile market. So next slide. So how can E&P companies react to lower oil and gas prices? Here's some common approaches or themes. One is operation adjustments, so focus on your core assets. That may mean deferring or even canceling costly projects and things like exploration, which we saw in our earlier charts, where there's less spend on exploration. General cost cutting and seeking efficiencies and lean operations. So tightening your budgets, reducing headcounts, maybe even squeezing your vendors. But really, this is sort of reactive and probably not sustainable. A little bit more optimistic or positive are things like adopting technology to increase production and reduce costs. And finally, the traditional financial risk management. So hedging to manage the volatility, locking in prices, portfolio optimizations and strategic positioning. So perhaps in a low price environment, there may be some distressed companies or assets that you can acquire. And I put in red diversification, but clearly diversification is a tool for managing volatility. But for true play, pure play oil and gas companies, that may be a challenge. And then as you saw on the earlier chart where companies have diversified a little bit into other new energies, they're perhaps not getting the shareholder returns that they're historically used to. So if we go, so what do we need to do in this volatile market? Well, first and foremost, I think there's a theme. We need to move from reactive, which some of those previous approaches were, to a more proactive approach. Next slide. So this little cartoon is sort of showing that in a volatile market, you need agility. And in my view, one of the prerequisites for that is to have options. When I speak to a lot of our clients, especially the smaller players, they're sort of like that on the left. They say, look, I don't have options. I just produce what I have. I just develop what I have. And what we notice often, they're sort of big chunky projects like we see here, A, B, C, and D. But I would argue that we have to find ways of having options. So, and there are ways. So there are the timing dimension. So projects can certainly be accelerated or delayed. And then for these big chunky projects, can we break them down into smaller wedges that align to capital spend? And ideally, that capital spend ties to maturing your resource and reserves basis. So therefore, those projects A, B, C, and D can be broken down into subcomponents. And then that's where the creativity comes, is both at a project level and then at an asset or corporate level. Can we come up with creative options? So is that maximizing NPV, maximizing reserves, minimizing short-term capital, going big or small on a development concept, going fast or slow? So through that, you're then going to have much more options, and you could potentially have various scenarios or versions, and these can be potentially mutually exclusive. So you could have, some from version 1, projects A, some from version 2, project B, and perhaps some from version 3, C, and D. And if you do have to reduce your budget, if you're on the left with few options, you're only going to be able to do A, B, and C, and actually not even fully utilizing your projects because you can't afford to do D. If you're on the right with many more options, you can actually mix and match and potentially use the full budget that has dropped from 100 to 90. So it just gives you more options. Next slide. So finally, I'd just like to talk about some practitioner tips for agility and adaptability. So first of all, going back to that sort of granular decision units, so that's what we like to call them at Quorum, decision units. Ideally, those granular decision units or investments are made to align to the resource and reserves maturation. Along those same lines is, where possible, perform incremental economic analysis. This is important specifically when you're dealing with complex fiscal regimes such as production sharing contracts. The order and the timing and phasing really does matter in value creation. Thirdly is just focus on what matters. So use traditional tools like sensitivity analysis, like tornado diagrams and spider diagrams to see what really moves the needle. So is that production? Is it schedule? Is it fiscal terms? Is it capital? And then once we know what matters, then try to build creative options to manage those uncertainty in those particular areas. Fourthly, looking at those mutually exclusive groups at a portfolio level. So you could have part of your business focusing on cash creation, others on maybe minimizing capital, and that combination gives you alignment of your overall portfolio. And last but not least, look at systems and tools that can help you gain further insight. So if you do use automation, you can do more iterations, more runs, and gain insights. And we at Quorum truly believe that AI is a game changer, and we'd love to speak to you about our vision of AI in planning. So with that, we'll go to the next section. And this is what I've been really looking forward to, a discussion with Pascal. Pascal, if you could come on to the virtual stage. So Pascal, how are you today? It was a pleasure to see you earlier in the year in Vienna. This is, I don't have quite the same pleasure, but it nevertheless, it's great to have you virtually. How are you? And maybe you can tell us what's new and exciting in the world of OMV.
Thanks, Raj. It's really a pleasure to be here. Thanks for the invitation. Well, at the moment, we just finished our midterm planning, so we are very happy we've delivered it, so we can pass and start working on other things in OMV. So that's this time of the year.
Okay. All right, well, let's get into it. So OMV has been a long-standing client of Quorum and, has been a very strong user of our planning space system. I love the name that OMV has given to that. It's called P2V, or Plan to Value. Could you maybe describe how OMV is using planning space or our P2V?
Yeah, thanks, Raj, for mentioning the name, so everybody will know that sometimes I will use planning space or P2V or plan to value for the product delivered by Quorum. Why it's named plan to value in OMV is because it's really core to our planning, so we really do everything with planning space, or at least for the economics part. So we start by, it's a very bottom-up process driven by our ventures, where they gather all the projects that they envisage to do in the coming years. They have planning objects. We recommend them to be class clean, so that a little bit of the breaking down that you mentioned could be always breaking more down, but it's a bit in that direction. And we also use different scenarios for each project. So we try to have P10, P50, P90 and failure cases, particularly for explorations. So already we have a little bit of a mix of possibilities and options for the future. As well, then we run several price scenarios, currency scenarios, and all thanks to planning space, so that we have at least a base and a stress scenario. Sometimes we have other scenarios that we need to see for sensitivities. We also deliver huge sensitivities result sets, so economics calculation to understand the break-even points for our projects. So we try to envisage what's coming, what are in fact moving the needle, as you were saying as well, and how do we envisage and place our different potential projects in the future.
Okay, that's great. I did mention earlier about the volatility in price, and when you were doing your business plan last year to, just now your midterm plan, the price has probably dropped, about 10%. Are you doing anything different because of that? And then, yes, I guess I'd just like to understand, has anything changed now because of the price drop?
Well, so since last year, yeah, you mentioned we had a better price overlook or forecast. We thought that it will stay much higher. It did not. So we have adapted our price scenarios for the future. But I think the idea is not necessarily to react too fast, because you cannot predict where the price is going to be, but more to have a resilient portfolio of projects that are going to be still strong, even if the price drops by 10%. And like this is the case, so that's why we look much more into our stress scenarios and like much lower, and really understand our projects are still strong. When do we break? So the break-even price is something we look very much into at the moment.
Okay. Well, as you say, no one can predict the oil and gas price. If I could, I would be definitely retired and a millionaire now. But clearly, it's never as exactly as you planned. So do you do any sort of performance monitoring throughout the course of the year? Like, are you tracking ahead or behind? And then how do you react, or do you react? Do you just stay the course, or is there potentially capital budget cuts? How does OMV sort of monitor how you're going against your initial plan?
So there are quarterly performance reviews against the plan, just looking at how we perform, or each project, each venture, each small project as well, or bigger project reacts. We always separate in two parts. So what we can do, which are the non-market effects. So if we have spent too much or not enough sometimes, like project delay for certain reasons. And we also look at the markets effect. So how is the project now? How do we foresee it in the future with the current market prices? And with this, then I don't take the decisions, but then our management decides if they need reactions, or if we're still on track because it's not so far off to what we had planned. And I think it's also a bit what is important, not to react too fast, because today it's going to be maybe 60, but maybe in a few months we are still going to be back to 65, and maybe that's better than what we planned.
Okay. So, with all you described so far, it sounds really, really robust in what you're doing. But with any system or any process, there's always room for improvements. So if you could change one thing or add one thing to your process, what would that be?
I think there is big room for improvement in using or approaching it more as a full portfolio view. So being able to play maybe even more into scheduling the project, finding out when is the better time, and also how to better optimize maybe the capex or our capital spendings, because there's never enough of that.
Okay. I was talking a little about the incrementals, and obviously, I know you, Pascal, you know how important that is in complex PSCs, but I think the incremental, even the mindset of having smaller wedges and seeing the impact of those wedges, does OMV do incremental analysis?
Yeah, we do use incremental projects everywhere. It's mandatory. But sometimes we have to be very close to the business, because we have to understand also the dependencies of the project. So it's sometimes not as straightforward as we would like from the finance point of view. But it's really important to also be able to shift the project schedules, and then to say, okay, but this project comes before, because that's the way we are going to be able to generate more value.
Yeah, I think it's pretty dangerous if finance is telling you everything, right? So yes, you have to work very closely with the business. So I'd love to talk as long as I could talk for hours with you, but we do have a time limit. So I'll ask one last question. Is there anything else you'd like to add that you think the participants here could learn or would be interested to hear from you and OMV?
I'm a big fan of planning space, because in a matter of a day, you can have an entire company rerun and have your new results to deliver if you have a very last minute change on your price forecast, for instance, which we really don't like to have, but it may happen. And this is something which is quite powerful, that we use a lot.
Well, Pascal, thank you so much. It's been great having this conversation. I think we'll move to the next part of the webinar. And if you could just stay on when we get to Q&A, I'm sure there'll be questions that you'll need to, that we would love to have your input on. So thank you very much, Pascal.
Thanks, Raj.
So with that, let's move to my colleague, Aaron, to show you some of our tools in action. Over to you, Aaron.
All right, thank you, Raj. So yeah, as discussed between you and Pascal, some of the keys to agile planning would include proactive scenario generation, giving yourself greater flexibility and optionality in your plan, and creating a robust plan where you win more often than not. So this demo will look at some of the tools that a planner can use to manage this volatile environment. So I think we all know, and as Raj discussed, the commodity price is the most common driver of uncertainty. And so one of the tools we can use for that is a break-even analysis. So this is an analysis where we're calculating NPV across many prices. So you can see on the screen there, there's we're calculating at $20 oil, $30 oil, $40 oil, etc. So it's fairly resource-intensive calculation. And for this particular project here, we'll generate a report, and then the result is this graph that's showing NPV on the y-axis versus price on the x-axis. So then our NPV is the point, or sorry, our break-even price is the point where NPV equals 0. And so in this case, this is $34 per barrel. So, you know, as a really simple analysis, right, if you want to win in most scenarios, right, you choose your projects with the lowest break-even point, break-even price. So, but keep in mind, this is just one metric and it does have limitations. It doesn't necessarily reflect the value of each project to the company. So further analysis would be needed, but that's a simple one to start with. So falling commodity price is one risk, but we need to consider other variables as well. So Raj was mentioning the use of sensitivity analysis. So this is where we're looking at multiple inputs and its impact on a certain result variable. So in this case, we'll select a result variable is after-tax cash flow. So it's a fairly common one. And then we'll look at the impact of inputs, changing inputs such as price, capital, operating costs, production, to see how does that change our after-tax cash flow. So we'll run this on our 2028 drilling program again at Johan Castberg, and we need to select our result variable, and then we'll look at it on an NPV discounted at 8%. So we'll run a report here, and the result will be a tornado diagram. And so what this is showing is the variability that each of these inputs has on NPV. And so in this case, it's highlighting that price and production have the largest impact on NPV. And so these are the variables that you really want to focus on, right? And in the case of production, maybe there's additional geological information you can gather to reduce that variability. Maybe you can shrink the project so that instead of it being a 2-well program, you just drill 1. And this analysis also shows us which inputs have less of an impact on project value. So in this case, capital costs and operating costs. So it's showing us where we should focus our efforts to maximize value to manage this uncertainty. So these first 2 examples have been looking at the project level, but typically it's more impactful to be looking to be analyzing at portfolio level. So this would be considering all your available projects, all your opportunities across the organization, and determining the best mix of projects and their timing to meet corporate goals. So in the list of opportunities here, you can see about 20 of them listed there, the Åsgard and Statfjord, King Lear, etc. And so there was an initial optimization run, but we'll clear that out, right? So those are the selections and their year of execution that has been included. And I wonder if the video has stopped. There we go. We're rolling again. And so we'll clear out all those selections. And so think of it, we're just starting from a blank slate, and we can choose our projects from here, right? So these graphs are showing the result at portfolio level. So we have no capital, no cash flow, et cetera. So these optimizations are typically, well, almost always subject to constraints, right? A typical constraint in oil and gas would be capital spending, right? We only have so much money to spend in a year. In this case, the assumption is 500 million per year. And we also have a constraint where we need to generate a minimum amount of free cash flow. So in this case, 180 million per year, and that's escalating over 2% each year. So now that we've established our constraints, I wonder if the video has paused again. So the next step will be to perform the optimization. And you can run the optimization on different variables. You can optimize cash flow or minimize debt, but in this case, we're going to maximize NPV. So maximize company value. So we'll hit OK. The optimization will kick off. And so what's happening here is the application is looking at different combinations of projects, different timings, running thousands of iterations to determine which combination maximizes NPV while living within those two constraints of capital and cash flow. So now the results, well, we ran it in advance, so we don't have to wait for the optimization to finish. But this is showing, again, that same list of opportunities, and then where a number appears on the right-hand side, that's the year of project execution. So it has determined this optimal mix of projects and their timing. And we can also take a look at the portfolio level. So we have capital on the left, and so you can see we're living within our capital requirement of spending 500 million or less. We have our free cash flow on the right, and so we are generating more cash flow than the minimum required. And so that scenario was based on $65 oil, but what happens on a $40 oil case? So this is another optimization that's already been run. And so here we have a different selection of projects. And the key takeaway here is it's showing on the cash flow chart, we're just barely making our constraint, right? We're above the line, but it's very, very close. And so you can look at that and say, oh, well, good news. We still meet our cash flow requirement in a $40 oil environment. However, this is based on there's underlying uncertainty here. Again, think of well performance or capital spending that underlies that P50 estimate, which is what we're seeing. So we can look at some of our other scenarios. We can look at the P90 scenario, that's the lower blue line now, or the P10 scenario, that's the upper blue line. And in the P90 case, we are in fact not meeting our cash flow requirement. So obviously that's not good news, but the advantage here is that we can do this proactively. So what Raj was talking about earlier, rather than waiting for bad news to occur and reacting, instead now we can see this coming and we can be proactive about it, and we can take action before the trouble arrives. Okay, and then what's on screen now is comparing the results of those two optimizations. So the $65 oil price optimization is in yellow, and the $40 optimization is in purple. So obviously you can see the difference in cash flow, and capital is always underneath the 500 million constraint. So this is showing it at a portfolio level, but then you may ask, well, what does this look like on a project level? How do these two scenarios compare? And so here's our list of projects, again, that I was showing at the beginning. And typically what you see in these optimization is that there's certain projects that are always included in scenarios. So in this case, you can see Åsgard, Statfjord, King Lear, and the Ekofisk based are included in both scenarios. So that's probably not the right spot to put your focus. And likewise, the Ekofisk Accelerate project is excluded from both scenarios. So where you want to focus your energy to maximize value in this environment would be on those Wisting projects that are included in the base price optimization, but excluded in the low price optimization. And there you can use some of the mechanisms that Raj was talking about, maybe making your projects more finer grained. Another interesting exercise to consider is what happens if you optimize based on a low price of, say, $40. So in this case, that's the blue lines, but you end up getting $65 oil as a price. So basically you planned conservatively, more conservatively than the price turned out. The other scenario in orange is where we forecasted based on a $65 oil price and we optimized based on that price. So the blue one is just conservative planning, right? So the good news is that in both cases, we're exceeding our cash flow requirements. But what I want to highlight here is the difference in NPV. So you can see, underneath the cash flow chart, it shows the NPV of the two scenarios. So where we planned for a $65 oil case, we have an NPV of 11.9 billion. Whereas when we planned conservatively, we have an NPV of only 9.2 billion. And keep in mind, these are both in a $65 oil price, you just planned more conservatively. So there was a potential cost of forecasting too conservatively in this case. So this is not to say that one is better than the other or that you need to have a crystal ball to forecast ideally. But what it is saying is that now you can see the trade-offs between the two, that you can plan more conservatively, you have more certainty to meet your cash flow requirement, but maybe you'll have lower NPV in the long run. And likewise, we can look at this at a project level, again, to see that certain projects are included in both scenarios. One project is excluded in both scenarios. And then it's the Wisting projects and the Ekofisk plan that is included in one scenario, but not the other. So again, those are the projects to really zero in on to maximize value in this uncertain environment. So yeah, that's a wrap for the demo. So we've seen a few examples of agile planning in action. So think about creating a robust plan, generating scenarios proactively rather than reacting, and giving yourself flexibility and optionality. So with that, I will pass it back to Kjetil for any questions we may have.
Thank you, Aaron, and thank you, Raj and Pascal. Thank you for the presentation and discussion and also the demo. I hope you who have participated had got a lot of new information about our planning space software and how it can be used and how it is used at OMV. We have now, let me see if we have any questions. Yeah, here's one. Many companies are still heavily reliant on spreadsheets and legacy tools for planning. What do you see as the biggest risks of continuing to operate this way in today's volatile markets? Maybe you, Raj, could give us a few words.
Yes, look, Excel is a good tool, especially if you're just doing one model or one asset. But if you have different models and having to run many scenarios, I think there's limitations of that. So that's one of the risks, because you want to be able to compare apples and apples and oranges. And so having a system that has some consistency is very effective. And then, as I showed the importance is to run many scenarios, generate many scenarios, and some of the tools like Planning Space allows you to do that in bulk and very quickly, including running different prices, etc. like that. And then if you fast forward a little bit to the AI world, which is rapidly coming, it's very important to have that everything in a database, because you need sort of that big data and to be able to scrutinize that data and have workflows that can be automated through AI agents. So I think that is going to be a big challenge for those companies that remain in Excel in the new world of AI. But Pascal, you've also been using Planning Space for many years. Maybe you could chime in and add more to what I just said.
Yeah, I mean, we've been using also the previous application before Planning Space that was old. And the entire prospect of changing from Excel to an application was mostly to have the possibility of standardization, making sure that your results are auditable at any time, that you are certain of how your computation are done, and not like someone has changed a cell in the Excel and you can't find it, so you have much more reliability on your results.
Very good.
That was very important.
Thank you, Raj and Pascal. Let us see what we have got here. Yeah, here is an experience question. From your experience, what are some common bottlenecks in corporate planning that prevent organizations from making faster data-driven decisions? And since this is experience, I will give it to our client. So please, Pascal, can you help us out?
That's a really tough question, I think. Common, I'm not sure, but here what we see is well, we never have enough capitals to spend, for sure. Yeah. So that's a bottleneck, because that's something what's driving our way of taking decisions. But maybe it's a part of expectation from the management. So expectations in that they want to try a lot of things very fast, and so with Planning Space, we have the possibility to give some answer in a day, two sometimes. With Excel, you will have to go through many Excel files, and that's not necessarily feasible. So here it's trying to manage, okay, what we can do, what brings value to take a decision, because you can bring millions of KPIs, but does that give you a better answer? Does that help you really to take your decision? That's hard. That's really hard in the planning. So you have to be quite focused on what is going to help you take your decision.
Very good. So let me see. Could you share an example of how digital solutions like Planning Space have helped an operator improve capital allocation or portfolio resilience in a real-world scenario? Maybe I just throw this out to everyone, or maybe Raj.
Yeah, well, I think Aaron's demo really showed that, right? Looking at things at a portfolio level, it's probably the area that's most important. An individual project, yeah, there will be projects that are, successful or performant or not, but the importance is in your overall portfolio. Is that the case? Now, I won't be able to sort of say specific names of companies or things like that, but I think that process is really where you need to evolve. Yes, looking at each individual project, trying to make sure you've addressed the uncertainties in those projects, but really what matters is the combination, right? And actually the ability to unlock value. So most companies are not that mature in portfolio analysis. They may do a ranking cut, They just rank all their projects by NPV, cut it at a budget, but then it doesn't handle the intricacies of, you know, the dependencies of those different projects, the realities of the business rules, etc. And that's the combinations, permutations are just so many. So I think that's where a tool like Portfolio and that portfolio thinking is really valuable.
Yeah, and I'll just add as well that the portfolio application doesn't give you the answer, that it doesn't say, okay, well, this is exactly how you need to run your business. But I think the key is it's showing those trade-offs between different scenarios. So what I was showing is that the one scenario is that you can forecast more conservatively. You know, you have more certainty to meet your cash flow requirement in that example, but it does have an impact on NPV. And I think it then makes it objective to management that they can see, okay, this scenario, we get this win, but we have this risk, and we can compare those scenarios. So it's not a question of giving you the answer, but it is, you know, initiating those conversations at a decision level.
Thank you. We have a last question here. I think it is all about getting a good start, I guess, because it's for organizations just starting their digital transformation journey in planning. What's the best first step they can take to see quick wins and build internal buy-ins? How can they show value very quick? Right, Raj, you know a lot of clients.
Yeah, so, you know, I'll go on my personal opinion on this. So the quick win is really at the portfolio level. That's, you know, management will love that. But I think the challenge of the industry in general is the data, right? So tackling it at the data level gives you the sustainability and the repeatability of that. But definitely from a quick win perspective, portfolio. But where my heart is let's make sure the data that goes into your portfolio analysis is very rock solid and you can trust it.
Good. I think that was that, and timing wise, we should be about on schedule. So I would, in the end here, let me just change the slide. So the question is your portfolio ready for what's next? And how can you find out? Yeah, you can contact us and we will answer you or direct you to the correct person. But we also have 2 ways that you can get this really a quick start. The first one is to book a demo one-to-one. And the second one is actually that we have made a package, an offer for a proof of concept, 1 month proof of concept for portfolio. And both these ways of for the next step together with us, the easiest way is now to scan the QR code you have on this slide. You will get these slides. I'll remind you about that later. But scan the code or just contact your local quorum representative and they will make sure that you get to the right people. The last thing to go through today is that we have the Connect 25 in Stavanger on October 16th. This is the client event. There will be presentations, there will be discussions, you will meet your peers from other companies, and you are, of course, invited. The easiest way to register is to scan this code that you see on the slide, and then we would love to see you there. Okay, so I think that's that. I would really like to thank our presenters. Thank you, Raj. Thank you, Aaron. And thank you, Pascal, for helping us out today. It is very valuable for us to be able to get the experience from our clients. And we will, of course, also thank you who has participated in this event and We hope that you really got some value from spending an hour with us. When you exit this webinar, there will pop up a survey. So take 2 minutes. If you can answer this, it will be of great value for us, and we can be even better the next time you are together with us in a webinar or other event. And then the last thing is that you will receive an email with the recording of this event. And I'll also just say again that please, any questions, if you'd like a meeting, if you'd like a presentation, anything, just contact us directly. Okay, have a great day.
Thank you.
Thanks.